A standard macroeconomic assumption dictates that rising risk-free interest rates in the United States inevitably drain capital from emerging market and developing economies. Yet historical data presents a strict paradox. Identical rate hikes from the Federal Reserve consistently cause wildly divergent outcomes in these developing markets. Consider this split-screen comparison of a 100 basis point increase in the U.S. two-year yield. In a benign historical cycle, emerging market sovereign spreads remain entirely flat. In a destructive cycle, like the 2013 Taper Tantrum, those exact same spreads violently spike, and the probability of an emerging market crisis hits 40%. This 2022 World Bank Policy Research Working Paper isolates the reason for this divergence. The raw interest rate isn't the cause of the contagion. The outcome depends entirely on the unobservable economic shock driving that rate increase. Surviving dollar volatility requires looking past the yield curve to decode the underlying intent of the Federal Reserve. To understand how this works, we will deconstruct the World Bank's three-step econometric pipeline used to quantify cross-border monetary spillovers. The foundational problem in monetary policy analysis is endogeneity. We cannot directly observe a central bank's internal shock or its true policy intent. Economists only observe the market symptoms, specifically Treasury yields, equity markets, and inflation expectations. The primary threat buried in the data is known as the reaction shock. This occurs when the Federal Reserve turns aggressively hawkish and tightens policy independent of economic growth data. Mathematically isolating the difference between a growth-driven hike and a reaction shock provides the statistical clarity needed to forecast an impending emerging market crisis. The first step of the World Bank's methodology relies on a sign-restricted Bayesian vector autoregression model. This matrix isolates the unobservable shock. A real shock occurs when growth drives rising yields, pulling equities up. An inflation shock combines rising yields with inflation, dropping equities. A reaction shock is unique. Yields rise, equities fall, but expected inflation actually drops. Analyzing the intense 2022 rate cycle reveals that reaction and inflation shocks accounted for 75% of the cumulative increase in U.S. yields. Correctly identifying a reaction shock isolates the true contagion vector targeting emerging markets. The second step of the pipeline involves mapping how this isolated shock spills over geographically into global economies. To map this contagion, researchers utilized panel local projection models spanning 36 emerging market economies over an 8-quarter horizon. The models show a real shock produces a benign outcome. Emerging market real exchange rates appreciate and sovereign spreads drop, supported by U.S. import demand. A reaction shock forces the opposite outcome, triggering aggressive capital outflows and depreciating emerging market currencies. This initiates severe secondary financial damage. 10-year local yields and sovereign risk spreads spike violently. The immediate fiscal consequence is pro-cyclical austerity. As credit tightens, emerging market governments are forced to cut expenditures simply to maintain their primary balances. This fiscal contraction shrinks the domestic economy, precisely at the moment when structural stimulus is needed most. Ultimately, a U.S. reaction shock acts as a wrecking ball, enforcing an austerity mandate on developing economies and crippling their growth potential. The final step of the econometric pipeline calculates terminal systemic failure using a random effects panel logit model. In this context, terminal failure for an emerging market is defined as a sovereign debt default, a banking collapse, or a severe currency crisis. The historical baseline probability of an emerging market financial crisis in any given year sits at a relatively low 3.5%. This logistics curve maps the outcome of a standard 25 basis point reaction shock applied to that baseline. A mere 25 basis point shock almost doubles the crisis probability to 6.6%. Because the model is nonlinear, the threat compounds exponentially as magnitude increases. Applying the aggregate 2022 data to this logit model requires plotting a massive 114 basis point reaction shock. The mathematical result is startling. The crisis probability leaps to nearly 40% for the average emerging market economy. This is not abstract theoretical modeling. During this exact period, historic numbers of emerging market economies approach the IMF for emergency financing. The nonlinear nature of this contagion means that once a reaction shock crosses a critical threshold, a wave of systemic crises becomes a statistical probability that is difficult for any emerging market to escape. This macroeconomic threat directly impacts the microeconomic reality of institutional capital allocation. Finance professor Campbell Harvey outlines a clear baseline mandate. A properly diversified institutional portfolio requires a roughly 50% international equity allocation. Looking at this standard portfolio distribution, the allocator faces a severe dilemma. How do you deploy capital into an emerging market facing a 40% probability of a macroeconomic crisis? Retreating entirely to U.S. equities is a mistake. It ignores valuation fundamentals and dangerously concentrates geographic risk. The answer requires focusing on micro-resilience. Investors must find structural buffers at the firm level capable of resisting sovereign macroeconomic contagion. Recent 2025 research analyzes how environmental, social, and governance implementation functions specifically within emerging markets during periods of extreme volatility. To survive a macroeconomic reaction shock, investors cannot simply buy index funds. They must identify individual companies possessing defensive structural characteristics that actively prevent capital flight. Researchers utilized firm fixed effects regression models to analyze 150 publicly listed emerging market firms across recent volatility cycles. The data shows that standard environmental and social metrics offer inconsistent protection, suffering from a severe lack of standardization and underreporting. The true structural buffer lies entirely in the governance vector of the ESG framework. Specific mechanisms of effective governance, primarily board independence and verified, transparent stakeholder disclosure, provide the necessary defense. These precise governance traits successfully lower a firm's cost of capital and maintain investor confidence, even during severe macroeconomic panics. Governance serves as the ultimate market differentiator, securing corporate capital when sovereign spreads blow out and regional credit dries up. Success in this environment requires differentiating macro noise from structural reality. Yields reflect the public symptom of tightening, while the underlying reaction shock represents the actual vector of financial contagion.